Hi, everybody. Welcome to Resources for Modern Retirement. I'm Loretta Saff, and I have with me today a very special guest. Her name is Carolyn Fleury, and she is a financial advisor. I'm going to remind you for one moment that the reason I'm doing Resources for Modern Retirement that I'm offering is because I think people think that retiring is something that's easy. I can just go right into it and I'll adapt right away. And many people do, and that's wonderful. But oftentimes people, after they have gone through maybe 6, 7 months of just trying very hard to make sure that they relax as much as they can, they get bored or they get nervous and they try to figure out what it is they're going to do. And so I like to offer a variety of different things that people can consider. And the people that I invite on this webcast are people who I feel would be approachable for no charge to talk to you about what it is you're thinking, the questions you have, and what to do next. Now, that doesn't mean that they don't have businesses of their own. Of course they do, but they also are experts in the field and they would be happy to take some time to talk to you. I'm delighted to have Carolyn with me today, and I will say that there will be contact information under her picture. If it's not there already, it will be put on after the recording. But Carolyn is, as I said before, a financial advisor. She is actually a wealth management specialist with Merrill Lynch, and I'm excited about having her and her expertise because very often what I hear from clients is that as long as I have a solid 401k, or as long as I look at my balance and know that my savings and in any investments I have is good, then that's fine. That's all I'll need. And I'm sorry about these things that are dinging on my computer, but anyway, to let you meet Carolyn, a little bit more about her. She helps people and families plan financially for the future. There's a nice thing to know. And of course, that's what everybody's worried about. How will I live? What will I do? Am I going to have enough money? But here's something especially interesting. After many, many years of working on Wall Street for Goldman Sachs and JP Morgan, Carolyn took a leave of absence because she was taking care of her aging mother. And so she witnessed firsthand those issues that people who are aging, who are getting older and maybe trying to figure it all out, what questions they might have. And now her mother was aging, and during that time, she needed some extra care. And so Carolyn went to go and help her mother. And during that time, surrounded by different people with different needs and different questions. After her mom passed away, she decided to use this financial knowledge that she has to help on the individual side, to help people make sure that they don't run out of money in retirement. Now, how many of you would like to have a good feeling that you're not going to run out of money in retirement? Yes, that's what I thought. Carolyn and her husband live in Nashville, and they have 5 kids. And by the way, they're all grown, launched, and financially independent. Hi, Carolyn. It's great to see you.
Thank you so much for having me on, Loretta. It's a pleasure, and I'm so excited to help educate people, and just to expand on, when I was visiting my mom kept saying way before she got ill, I'm fine. Well, guess what? She wasn't. I had to sell literally all of her assets to fund her long-term care. And we'll talk about this, I'm sure, I think. And it just was such an eye-opener. And I mean, when she passed, I actually had to write an $18,000 check to finalize bills and she wanted to be buried next to my father in Arlington, Virginia, and to get all that done. And thank goodness I was able to do it. But it was a real eye opener because people, as you said, think, oh, I've got a 401k, it's fine. But there are all these other what ifs that I love to address, and not to scare people, but we got to think about that when we're planning for retirement.
All about the education part that you just said, because we just don't think about it. And especially if people are healthy, then that's even more like, I'll take care of things. I'll get to it. I'll make it happen. Let me ask you, first of all, how should a person choose a financial advisor? And I keep hearing this term fiduciary. Can you talk about that a little bit?
A great question. So I always say picking a financial advisor, it's like picking your doctor. You need to trust and like the person. Look at their history. But I think getting along, having that connection is so important. I would say 70% of my clients are actually women, just because sometimes women like to work with women. I work with all ages and sexes. So don't get me wrong, the men out there, I'll be happy to talk to you. But you've got to find that connection. I'm from New York. I talk fast, I walk fast. Not to say that in Nashville, I have a lot of clients in Nashville, but having that connection, whether it's a mother of 5 kids, having something that you can connect with, you got to trust that person. The fiduciary part of it is, I am not what I call transaction based. I am working as a fiduciary, meaning I am acting as if I were you. I'm making the decisions based on your goals, what your risk tolerance is, on behalf of you. I manage your money, grow it, protect it. Of course, I always talk to my clients saying, here's what I'm thinking. This is why I'm thinking of this plan or making this change. I get your approval. And my whole goal is I try to basically wipe away the mystery. I try to put things in layman's terms, educate people. I know what I do well. I am not a plumber. I had a plumber the other day come in and fix the gasket on I had a leak, and I'm like, but he explained, he's like, listen, it's just one little part that has to be fixed. I'm like, great, go ahead. I try to make the same thing in terms of the financial things, make things, make sure you understand it, because knowledge is power. And I love to educate people on what I'm doing and why. And that's where I act as a fiduciary on your behalf.
So the other financial advisors or wealth management people that are out there, if they don't have that term fiduciary, what are they doing? I thought that they're supposed to be working for me too.
So that's a great question. A lot of them are basically transaction based. So every single trade they make, that's how they get paid, is based on the trade, the transaction. They're not saying, oh, this is best for my client because we need to rebalance or diversify. They're all about transactions. And it's fine if that's what your mojo is. But if you're really looking for what I call a holistic planner, that's somebody that's going to take all your pieces of your stuff into consideration. What do you have? What are your goals? Do you want to leave stuff to retirement? Do you have cancer and dementia in your family? If you do, my guess is you probably will need some sort of long-term care down the road, because that is very hereditary. So, and to look at all the big pictures versus just do what I call the trading part of things.
I see, which actually brings me to my next question, because you just mentioned that term, long-term care and long-term care insurance. What if you don't have it, if a person doesn't have it now? First of all, do I need it? And secondly, what if I don't have it now? I keep hearing stories about how when you're older, it's so much more expensive, and you probably made a mistake not getting it earlier.
Yeah. And long-term care got a bad rap, I must say, probably 10, 15 years ago, because a lot of companies issued it and then they didn't realize that they'd actually have to pay out on it. And so what happened were a lot of companies that issued it actually went bankrupt. Long-term care is a very critical part of financial planning. Is it for everybody? That's on a individual basis. But the good news is we're all living longer, but we're all living longer with more chronic diseases, which is where the long-term care comes in. And long-term care, people would think, oh, well, I've got Social Security, I'm going to have Medicare. No, that doesn't cover long-term care. Long-term care is if you've got dementia, or you're even if you broke your leg or hip and have to be in a facility for rehab for 6 months, long-term care insurance pays for that. A lot of people also get the question, well, I have something through work. Well, that's fine. But you know what? When you retire, you lose all those benefits. You don't continue that. So long-term care is definitely a question I ask a lot of my clients, because like my mother, if you don't have anything, and she did not, you have to think about, okay, what are your assets that you're going to have to dip into to sell to fund your long-term care?
And it's very expensive, is that correct? Or how do they decide, or how does one decide which long-term care policy? Do you help clients with that?
I do. Yep. And it depends on people's lifestyle. I have some clients that are like, you know what, I want to stay in my home And I'm like, fine, well, then you're going to have to probably hire somebody. Maybe 4 hours a week is the average, but if you get to a certain stage of life, you might need round the clock care. What does that cost? It's probably about $7,000 to $8,000 a month. And then I put out, a spreadsheet for my clients saying, okay, let's assume age 80, you're going to need this. We're going to have a chunk of money that we're kind of putting aside to fund that if you can't get long-term care. And here's the trade-off. There are lots of different options in terms of long-term care. You can do what I call pay as you go, meaning every month. If you don't use it, say you die of a heart attack, you lose it. That's the old style of long-term care. There's also a lot of long-term care options that are what I call asset-based, where basically you move like a chunk of lazy money from one account into another. You still have it. If you never use it, it gets transferred to your beneficiaries, but day one, you get 5 times the amount, depending upon the style, of a pool of money that you can use for long-term care. So there are lots of different options out there. I definitely go through, and it's based on what other assets you have, and it's very specific to the individual.
Am I hearing you say that everyone should have it?
I think so, because we are living longer. Our census before people retired at age 65, the average death rate 30 years ago was age 75.
Mhm.
Guess what? We're living a lot longer these days. And because we're living longer, when you're 85, 90, 90% of us will need some sort of long-term care. So yes, I highly recommend long-term care, unless you want to spend all your assets and leave nothing to your legacy or your foundation. So that's where that comes in. Like my mother, she was like, I'm fine. Well, she did not have long-term care. So I had to sell all of her assets to fund her long-term care. And she left nothing to her children, which I know she would have been mortified about.
Well, it's an eye opener. Thank
Yeah.
you. Now, a question that comes to mind is a question that I think most of your clients would ask is, how do I invest my money so that I can live the lifestyle that I'm used to?
Yep.
This is the way. I don't want to have to suddenly go into a 900 square foot place when I'm used to a decent sized house with several bedrooms, et cetera, et cetera. What do I do to be smart?
So I have a lot of software and calculations that basically say you are living on $10,000 a month is your annual income that you spend. Guess what? In 20 years, I take into consideration inflation as well, because in 20 years, that $10,000 a month of your living expenses is probably going to be more like 25,000. So then I do a calculation that says, okay, if you want to live the same lifestyle, how much do you need at retirement to pull off that $25,000 in retirement and still maintain your lifestyle? So I have all sorts of calculations. It also, it goes into your risk tolerance. What other assets do you have? I'm a huge fan of diversification. I like to have my clients diversified because with all the volatility in the market going on, don't put all your eggs in one basket is sort of my saying. So diversification is key. The younger you are, you have more time to absorb that market up and down. So you can be a little more aggressive. I have a 58-year-old who's just a brand new client, and he wants to retire in 7 years. So we're taking his retirement and being a little more conservative because he's going to be fine, but we don't want to risk that. He's like, you know what? I'd rather have that money for me and make sure me and my wife can live the comfortable lifestyle we want.
Sounds like you listen to the client too, and that's wonderful to hear, because you feel like you're well taken care of, and that's just so important. Well, it makes me think about, I have a house and the house is nice. And then I keep seeing William Shatner and all these other people say, I got a reverse mortgage and now I am comfortable and my conscience is clear because I have my house and I have my money. And so what do you think about reverse mortgages? Did you just freeze? I think you just froze. Carolyn? Oh dear. Okay, I think you're moving now.
Okay, sorry about that. I can see you. So reverse mortgages, I like them. They're not for everybody. The way they work, and I like them because interest rates are so low right now. So here's a statistic. A lot of people think, oh, I'll give my house to my kids. Your kids don't want your house. 90% of the time, they're like, this is outdated. I don't want to live here. I want to live in a high-rise apartment. So if you can pull your equity out of your house and use it for your retirement and your long-term care at the low interest rates we have right now, that is a great thing. And the way those work is that when you pass, your family will actually have your spouse can live there, so it doesn't end just when one spouse dies. And then when both spouses pass, the children have, I think, depending on which one it is, 12 to 18 months to sell the property and pay that reverse mortgage back from the funds. So a lot of people think, oh, well, they're going to own the house, and the minute my parents die, they're going to sell it. That's not the case. You can come in if you want to renovate it. So it's a great way of pulling the equity out of your house and use it for your financial needs in retirement.
It's so interesting because that's not something that we learn when we just hear these snippets of what it's all about, and
Exactly.
instead we look at the TV or some hear it and we say, no, don't you realize you're no longer going to own your house? So thank you. That's really
But
interesting.
you still own it. You still own it. You're just giving part of it up to the bank to get that cash to use. And so the way it's structured too, you can either get a one-time payment or you can get monthly payments for the rest of your life as well.
I see. I see. Um, what do you say to clients that say, when should I retire?
Uh, that is that's more of a conversation probably for 2 hours. But the question is, what are your goals? And then I look at, if you want to retire at age 55, let's look at your financials. And that's where it combines the two. I'll say you can retire, but you're not going to be able to live the lifestyle you have right now. So it really is balancing what your income is, what you have in savings, what I can project that hopefully will produce income when you retire, and what your goals are. I've got some clients that say, you know what, I want to downsize. I don't want to have the 10,000 a month budget. I'm happy on 2,000. Let's downsize, and that's fine. So it really goes to the individual desires, and that's one of the, I ask a lot of questions with my clients, and I listen a lot, and then I absorb it, and those goals might change as well, Loretta. It you might think now you don't want that, but then also you're like, you know what? Now that we're truly empty nesters, let's travel more. And I put that in the budget and I figure out the way to do that. So, when you have a financial plan, and when you work with financial advisors, you've got to have a financial advisor that works with you, that listens, that's always, meeting with you on a regular basis. Because life happens, life changes. So it's not putting a plan in place and then forgetting about it. You've got to constantly revisit that. And that's what I do.
And it's very interesting because as a retirement coach under the non-financial umbrella, all of those things you say apply to what I do, because people can get all of those things. They have the goals in mind with what they want and how they're going to live. But it's that big question of, how are you going to live? What are you going to do every day when you get up? So everything you're saying is just exactly what I tell my clients all the time. And now that financial piece, I've never turned away from the financial piece. It's just like the plumber. I don't know how to do your financial piece. And so therefore you need an expert, and that's just make sure you have it so that you're not caught short. If you were to give advice to people who are, say, 5 to 7 years away from retirement, what would be some of the top things that you tell them to make sure that they do?
That's a great question. Number one is, what are your goals? Just what do you like to do? Do you like to play golf? Because guess what? Backing it up, when do we spend our most money? It's usually on the days we don't work, like Saturdays and Sundays, whether it's you're going out to the golf course or you're going to the store. So what happens in retirement, I often say is, guess what? People get in the trouble. They don't budget. So budgeting for retirement is key. And what does that lifestyle look like? If you want to play golf 3 times a week, that's great. But if you don't have a membership, that's going to be, let's put that into the budget. What I also asked too, in terms of, if you did not have this income coming in, would you be okay with market volatility and seeing your savings go up and down? Because whenever you pull out from your savings in a down market, it takes 2 or 3 times as much time to build that money up in an up market. And that's just basically a cash flow view of the financials. So I go through that with my clients. I love what I do, but there's some people that are like, you know what, I'm just doing this for the paycheck, and I listen for that as well. And then I also have the question like, listen, have you thought about, can you do some sort of part-time job or some part-time hobby to help supplement your income if they don't have the basics right now to retire on in 7 years?
Absolutely. What great advice. What great. Just as a quick aside, I once said I was dealing with someone who was a CFO, and I said to him something about, well, tell me about some of, your hobbies, some things that you do. And he looked at me and he said, hobbies? Do you think I have time for hobbies? And I said, okay, no, let's call it passions. The things that you really enjoy doing that you can lose yourself in as far as time goes, because that's really something that you want to do and that you can do.
Mhm.
Just a couple of quick final things. So many of the financial terms are thrown at us and we don't always know what they mean, like annuity, distribution, net worth. Do I really need to know those? I mean, I often tell my clients is that if you can't pronounce it and you don't know what it is, the chances are you shouldn't really own it. And yet I'd like for you to tell me whether that's the proper advice.
Well, that's one more reason why you need a financial advisor, because the financial advisor, in terms of distributions, when you turn 59 and a half years old, you're required by law to take some distributions out of your retirement account. Because think of it this way, that money has grown tax-free. The government wants to be paid back their taxes. You're required to take a certain percentage out every year, and that becomes taxable income. So that's how the government gets their taxes. If you don't do that, you are even penalized more. So your financial advisor should be taking care of that. I mean, it's automatically in our system. I know exactly, and you can take it January 1, you can take it December 31, but you've got to take a certain amount when you turn a certain year every year from your retirement accounts. Annuities are great for everybody. Again, your financial advisor should be looking at the whole picture and saying, okay, you don't have a retirement pension. Not many jobs offer pensions these days. So annuities are a great way of providing stable income in retirement. It's not for everybody. There are lots out there, but that's something too, you should not be worrying about yourself. Hopefully your financial advisor will bring that up if they see a gap in your income needs going forward. And again, I don't know all the plumbing tools, and that's why it goes back to, you should hire a financial advisor to help you assist you with this.
Well, then that makes me think of this one last question, because this last year that we lived through with COVID, if I'm going to trust somebody and take, here's my strong box of money or all of my listings of what I have, and they're virtual, then, should my antenna go up, or should I feel like, how should I judge that? How should I decide?
And that's a great question. We were talking earlier, I think the last year has taught us one thing, that we can do a lot of things virtually. But there are some people out there that like the old fashioned in-person, face-to-face meeting. And I do that as well all the time. When you hire a financial advisor, I would definitely ask for recommendations, check them out, check out their webpage, their LinkedIn profile. It's like anything else, do your due diligence, but make sure too, you find that connection, because you are trusting somebody with your finances that you work so hard for, you and your family members. And you want to make sure that person has your fiduciary alignment, but understands you and understands what your goals are. And I think really to do that, you've got to have, I think some people we can connect like face to face via Zoom and get to know that person. But if you are the in-person kind of person, you want to actually see the facial expressions and everything else in person, push for that. Say, I want to meet in person. And I don't think that is something that I do. But it's something too, I think we've also realized, and in terms of the documents and stuff, everything most financial advisors have secure documents. So if you submit a document, it's not going to get lost and hacked somewhere else if it is a reputable firm. So that should be of no worry to you.
Perfect. Well, this has been fantastic, Carolyn. Can you please tell our audience, and as I say, they will have underneath your picture, and as we're talking the whole time, they will have all of your contact information. But can you verbally tell everyone about it, please?
Yes, it's Carolyn.Fleury. So CAROLYN F as in Frank, LEURY at M as in Mary, L as in Lynch, Merrill Lynch.com.
Perfect.
And then I always give, my phone number is 603-276-8201.
Thank you. Carolyn, it's been a pleasure. You really have helped everyone. I think that it becomes so much clearer now to understand what wealth management people do and the responsibility of the person going to the office or figuring out who they're going to choose.
Well,
thank you so much.
No, thank you. And if anybody out there listening, if they want to give me a ring, I'm happy to do my first consult I don't charge for that. So I'd love to meet with anybody and answer any small questions as well.
Perfect. Thank you.